Okay, so this is the 2023 Goodwin Plc published accounts question. So it says, Goodwin Plc has an authorised share capital of €800,000 divided into 500,000 ordinary shares of €1 each and 300,000 4% preference shares of €1 each. The following trial balance was extracted from its books on the 31st of the 12th, 2022. So below that you can see the trial balance with all the balances from that year. So it says, the following information is relevant. Number 1, stock on the 31st of the 12th, 2022 was €90,000. Number 2, during the year, the land adjacent to the company's premises, which had cost €165,000, was sold for €250,000. At the end of the year, the company revalued its buildings at €930,000. The company wishes to reflect this valuation in this year's accounts. Number 3, provide for debenture interest due, investment income due, auditor's fees $16,000, director's fees $45,000 and corporation tax $99,000. Number 4, included in distribution expenses is €14,000 for commission earned. Number 5, depreciation is to be provided for on buildings at a rate of 2% per annum straight line and is to be allocated 20% to distribution costs and 80% to administrative expenses. There was no purchase or sale of buildings during the year. Depreciation is to be provided for on vehicles at a rate of 20% per annum on a reducing balance basis. Number 6, the patent was acquired on the 1st of the 1st, 2018 for €171,000. It is being amortised over 9 years in equal instalments. The amortisation is to be included in the cost of sales. Number 7, the company is being sued by a former employee who is claiming unfair dismissal. The former employee is seeking compensation for €72,000, 2 years' wages. The company's legal team has advised that, as all proper procedures were followed in the course of the dismissal, it is unlikely the compensation will have to be paid to the former employee. The company has received an invoice for legal fees to the value of €9,000. So required, Part A, prepare the published profit and loss account of Goodwin Plc for the year ended 31st of the 12th, 2022 and the balance sheet as at that date in accordance with the Companies Acts and appropriate accounting standards, showing the following notes. Number 1, accounting policy note for tangible fixed assets and stock. Number 2, operating profit. Number 3, tangible fixed assets. Number 4, dividends. Number 5, contingent liability. And that's 90 marks. Then part B for 10 marks. Number 1, explain what is meant by an audit. And 2, outline the factors that an auditor will take into consideration when forming their opinion in order to prepare their report. Okay, so let's get going with part A. How we would go through this question, we'd take the following steps as per the final accounts in question 1, and then all you have to do after that is complete the notes of the accounts and complete the theory element to the question. So step 1 would be prepare the layout. Step 2 would be enter the figures from the trial balance into your working sheets or the face of the published TPL and balance sheet and make sure you're ticking everything off as you're going along. Step 3, work out the investment income or investment income due, and debenture interest or debenture interest due. Step 4, start on your adjustments. Step 5, tot up all your totals in your published TPL and balance sheet. And then your step 6 and 7, doing your notes and doing your theory. Okay, so step number 1, lay out the accounts, 9 minutes maximum. Okay, so you have 45 minutes to do this question. So if this takes 9 minutes, that's brilliant. So this is a huge learning curve when it comes to published accounts. You have to learn the layout of this question. Okay, it's very important that you do. This is a published account for external use and you need to make sure that everything is in the correct order and that every single word that you see in the page here is written down in your exam in June. Okay, so you've got your heading, the published P&L account of whoever for the year ended 31st the 12th, whatever it might be the year is, and then you've got turnover, cost of sales, gross profit, distribution costs, administration expenses, other operating income, operating profit, exceptional item, income from financial investments, interest payable, profit on ordinary activities before taxation, tax on profit on ordinary activities, profit on ordinary activities after taxation, dividends paid, retained profit, profit and loss balance 0101, and that is equal to the profit and loss balance 31st the 12th. Then in the balance sheet here we have fixed assets, which have our intangible assets, tangible assets, financial assets. Current assets, we have stock, debtors, bank. Creditors, we have amounts falling due within 1 year. We have trade creditors, other creditors, taxation. Net current assets, total assets less current liabilities. Then we have creditors, amounts falling due after 1 year. And then we have whatever the percentage is, debentures. Then we have capital and reserves, issued shares, revaluation reserve, profit and loss balance. And this here is our tangible fixed assets note. Okay, it's one of the 5 notes. It's usually worth about 7 marks. Okay, but we're going to do it at the same time as we're doing our published P&L on balance sheet, because we need the results of it to get the intangible assets and the revaluation reserve figures anyway, so we might as well do it as we are going along. Okay, step number 2 is entering the figures from the trial balance into the account. So we're taking all of these figures from the trial balance and we're putting them into the accounts or into workings. So you can see here, I've put a few figures into the face of the accounts, right? That is not necessary for you to do that if you're not sure that you can do this straight away. But when you get more used to doing this question, you'll realise, dividends paid never changes. The P&L from last year definitely never changes. Tangible assets, financial assets and the debentures never change. The bank, I haven't seen that ever changing. Other creditors, I've never seen it ever changing. And the issued shares, I've never seen that ever changing. So there's never been adjustments on them. You will get to know that as you do more and more of these questions. But if something did change to any of those items, that's grand. You just take the original figure and you amend it, okay? If you're not too sure about putting them straight in, you can do the workings on here. Make sure you write the figure down somewhere though from the trial balance, because a lot of people will leave out figures from the trial balance and then they will lose valuable marks for just leaving them out. Okay, so we're going to go through it bit by bit and show you how we did this. So the first 2 figures there, buildings, and then the buildings accumulated depreciation. You can see the 750 and the 60 here. So you can see I do have the 60 here, but this 915, that's 915, that's not 750, what we see here. Okay, so we need to figure out, right, why have I changed that to 975? Well, if you remember in the notes, okay, and this happens in every published accounts question, it says, during the year, the land adjacent to the company's premises, which had cost 165,000, was sold for 250. So at the start of the year, they did have land that was 165. Okay, so 165 and 750 is the 915 land and buildings that they would have had at the start of the year. Then you've got your accumulated depreciation, the 60,000. So 915 minus 60,000 is equal to 855. Okay. Then we've got vehicles. So vehicles at cost 510,000. Then you've got accumulated depreciation of vehicles 204,000. That gives you then a net book value of 306,000 euros. So 510 minus 204 is equal to 306. Then you've got your financial assets, 300,000. Then you've got your debtors. Okay, so this debtors figure, it's always going to change. There's always going to be adjustments in this. In every question there has been, so we'll anticipate that there will be again. But creditors, there's never been any adjustments, so that's why I put it up there. If you wanted to put, if you wanted to do a work and trade creditors 356 and just wait and see was there any adjustments, that's absolutely fine as well, just as long as you have the figure down somewhere. Stock on the first, that's going to go into your cost of sales figure up in your published P&L. The patent, that's an intangible fixed asset, and we will most likely be having an adjustment on that, so we just wrote down in the workings. Admin expenses is going to go into the workings as well. Distribution costs into the workings also. Insurance is going to be added to admin expenses because insurance is an admin expense. Bad debts is a selling and distribution expense. So if we thought about selling and distribution in question 1, right? Bad debts is when your debtors are not paying you. So that is going to be into the distribution costs, because distribution costs here is our selling and distribution from question 1. So bad debts goes in there. Purchases and sales. So purchases is going to go into the cost of sales, and sales is going to go into the turnover. Then we've got rental income. So rental income is going to go into the add operating income. So the other operating income. Okay. So in question 1, it would go into operating income. Profit on sale of land, that is an exceptional item. Okay. So an exceptional item. That is an item of significant size, okay, and it has to be put on its own because it is so significant, okay. So the example would be like a really large bad debt or profit on sale of land, for example. So you'll see here that is exceptional item there. That will be profit on sale of land up there. So we'll just put the 85,000 down there. Dividends paid, we're firing that into the published P&L. You've got the bank figure. They never tend to change that, but they might, okay? And all you'd have to do is just a little working on it if they do. That will go into taxation in the balance sheet, but we'll do working on that. 6% debentures goes into creditors plus 1 year. Profit and loss account is going to go into the P&L here. This side here, if you remember your alert diagram, A, L, E, R, and then the T from doing all our question 1s, okay? Profit is a liability to the owner, okay? So if the profit figure is on the credit side, that means it's profit. If it's on this side, it means a loss. So in this case, it is a profit, and that can go straight in because that's from the start of the year. Investment income is it's got its own thing here, income from financial investments, okay? So income from financial investments, the whole amount for the year will go here, okay? But we've received 7,000 and there's always going to be investment income due. So we can imagine when we go to work out what our investments are, that the amount is going to be more than 7,000. So we've received 7,000. Let's imagine the amount for the year is more than 7,000. That 7,000 is going to help us establish how much investment income is due, which will go into the debtors up in the current asset. So in this case, debtors is just everybody that owes you money. Issued capital then, okay, we are going to add up the two figures, the 300 and the 250, and that is going to be 550. Next, we have provision for bad debts. So provision for bad debts is going to be taken away from the debtors figure in the balance sheet. So the debtors, again, let's just say that is everybody that owes you money. Okay. Debenture interest paid then, 9,000. So the debenture interest, all right, will be interest payable up here. What we will have here will be the amount for the current year. Now, every year, as I said, they will have debenture interest due. Okay. So debenture interest due, all right, you have an amount that you will owe to your debenture holder. So the amount that you'll owe to the person that you borrowed from, you will definitely owe some at the end of the year. And so that will go into other creditors here. So whatever the debenture interest due is, will go in there. We're going to work that out next in the next step anyway. And then the last but not least, we have discount. It's on the credit side. So remember in our alert again, that is discount received because it is on the credit side. So discount received, other operating income there. So add discount received, 33,000. So that is all of your step 2 done. You've got all of your figures in from the trial balance, and you've got loads of marks already just for having everything written down on the page. So big mistake of people is just not entering in figures anywhere. Okay, step 3 then. Investment income and mortgage interest. Okay, so take about 4 minutes to do this. So this is the same step 3 as we have in question 1. Right, so if we're looking at our investments, okay, 3% investments, okay, purchase on the 1st, the 2nd, 300,000. So 300,000 multiplied by 3%, multiplied by 11 over 12 months, because that is how much time we had the investments for. So for the current year, Goodwin Plc would be getting €8,250. Okay, investment income. Now, if you remember, we received 7,000 of that. So that means that we're going to have investment income due 1,250 down in our debtors working. Okay, so at the end of the year, we owe 1,250. Okay, then if we look at the debentures next. So the debentures down here, 6% debentures secured until 2028. So we have to pay them back in 2028. So 200,000 by 6%. That is €12,000 debenture interest we have to pay for the whole year. Now the debenture interest down the bottom here, okay, we've only paid 9,000. So debenture interest 12 minus 9, we're going to have €3,000 debenture interest due at the end of the current year, which is going to go into our other creditors working. Okay, so that is our step 3 done, just establishing how much is the investment income for the year, how much is the debenture interest for the year, and then how much are the amounts due at the end of the year. So it's a good practice to get into it, just like our question 1 questions. Okay, step 4 then, we're going to start in our adjustments. So this is going to be a lot less work than our question 1, okay? There is a lot less work involved here. So 15 minutes should be all it will take, and then we've still got 19 minutes to do everything else. Okay, so first one says stock on 31st of the 12th, 2022 was €90,000. So stock on the 31st of the 12th, 2022 was €90,000. Okay, so we obviously know that our closing stock always goes into our cost of sales in our cost of sales in our published P&L, okay? And then the stock is going to just go up in the current assets in the balance sheet. So it rarely happens that there is an adjustment to stock. So that's why I've put it straight in there as well, okay? But in your year, there might be. So there might be a tiny little adjustment, and so you just adjust for it as you would in question 1. Okay, so that's the first adjustment done. Second adjustment says, during the year, the land adjacent to the company's premises, which had cost 165,000, was sold for 250,000. At the end of the year, the company revalued its buildings at €930,000. The company wishes to reflect this valuation in this year's accounts. Okay, so land which had cost 165 was sold for 250. Okay, so 165 and 250. Right, so that is 85,000 profit that they would have made, and we got that 85,000 in the trial balance. It said profit on sale of land. Okay, but at the end of the year, they decided to revalue the buildings to 930. So let's have a look and see how that will look in our account. So look, we're firing the 85,000 in here. They also accept it if you say profit on sale of land instead of exceptional item, but I would just in case, I would write down exceptional item when you're doing your layout. But that's what that is, that 85,000 is. Now, they've revalued the buildings to 930,000. So you're putting the 930,000 down here in the net book value, okay? In your cost part, so this is all about the cost, this first section up here, okay? This is about depreciation, and then this is net book value at the start of the year, net book value at the end of the year. So let's just remember, right? We had a cost on the 1st of the 1st, okay, of 915. That was the amount from the trial balance plus the 165 land that was sold during the year. So we sold the 165 land, okay, and now we're revaluing our land and buildings to 930. So we had to figure out then that €180,000, right, is part of the revaluation reserve, okay? So it's jumped up from 750 up to 930, so that's €180,000 in that revaluation reserve. We'll also figure out we need to rewind all of our depreciation that's ever taken place on our land and buildings as well. So we'll do that also. Okay, we'll do that in a while. Okay, in the next adjustment. So, not the next adjustment number 5. So number 3, provide for debenture interest due, investment income due, auditors' fees 16, directors' fees 45, and corporation tax 99. So look, provide for. This means all of these have to go into the balance sheet as well as your trading profit and loss, because we have not done this yet. We have not provided for it yet. We have not put it into our accounts that this needs to be done. Okay, so debenture interest due, we have already worked out that was €3,000 there. We've already worked out the investment income due as well. Now, the auditor's fee, 16,000, needs to be added to the admin expenses. Okay, and it also then needs to be added to the other creditors because we have not paid that yet. So we need to add that to the amount that needs to be paid to people. So that's going to go into the creditors minus 1 year as well. Now the director's fees, 45,000, is going to go into admin expenses also. And then it's also going to go into the other creditors because we have not paid the directors the 45,000 yet. So we need to say that it is going into the creditors minus 1 year into the other creditors. So here we've got the trade creditors, which is just the people we buy on credit from, but other creditors is just absolutely everybody else that we owe money to. Last but not least then, we have the corporation tax. So they're saying that we have to provide for corporation tax. So that's 99,000 there in the tax. And then we're taking the 99,000 then away from tax on profit on ordinary activities. So tax on profit on ordinary activities. Okay, so that's 99,000 there. And that is that adjustment done. So adjustment number 3 is done now. Next, we have adjustment number 4. So it says here that included in distribution expenses is 14,000 for commission earned. So this is really silly. This is a complete and utter mistake, right? So the bookkeeper did something really stupid here. They should have put, if they had 14,000 commission earned, right, how they should have recorded that would have been into the commission account, okay? Now, commission paid would be on this side because that's the expense side, okay? But commission received would go on the credit side. So 14,000 should go there, okay? That's exactly where that should go. Now, that's not where the bookkeeper did put it, right? So the bookkeeper made a very, very, very silly mistake and they put it into the distribution expenses. Now, distribution expenses would be on this side, okay? But if they put 14,000 commission received into the distribution account, that would have reduced the distribution expenses, right? So for us to fix this, right, what we'll do now is we fix it. We would have to put in the 14,000 into the commission received, okay? So we'd have to record that in like an account receivable, so the income account, okay, other operating income account, and then the distribution expense. So for us to enter that in, we'd have to enter it. For us to fix this, fix the distribution, we'd have to put the 14,000 on the debit side, okay? So the distribution, the other operating income, add commission earned €14,000. Okay, so that would go in there. And then distribution cost, then that is why we are adding the 14,000 commission earned to that. It seems a bit funny because you want to take it away because you think to take something out of something you would minus it, but in this case, because of the double entry rules, we would actually have to plus it. Okay, so that is that adjustment number 4 completed then. All right, next one, note number 5. So this will finish off our tangible fixed assets note. So here it says depreciation is to be provided for on buildings at a rate of 2% per annum straight line and is to be allocated 20% to distribution costs and 80% to administrative expenses. There was no purchase or sale of buildings during the year. Depreciation is to be provided for on buildings at a rate of 20% per annum on a reducing balance basis. Okay, so depreciation is to be provided for on buildings at a rate of 2% per annum straight line and is to be allocated 20% to distribution costs and 80% administrative expenses. There was no purchase or sale of buildings during the year. Okay, all right, so per annum straight line, so that means the exact same amount every single year. Okay, so they want you to do your buildings. Okay, now remember, we do not depreciate land. Okay, so we don't depreciate land. We sold 165,000 worth of land during the year. Okay, the buildings that we had, okay, during the year were the 750,000 that was in the trial balance. Okay, they revalued them at the end of the year, the 930, but we have to use the figure that we had at the start, which is 750. And then we'll multiply that by 2, and then we'll split it up 20% into distribution, 80% administrative. Okay, and there was no purchase or sale of buildings during the year. Okay, so we'll just do that one first. Okay, so if we work out, right, the buildings depreciation, we've got 750,000, okay, multiplied by 2%. That is 15,000 altogether. Okay, that 15,000 is going to be written in there for the charge for the year. However, we were told to split up the 50,000. We were told to split up the 50,000, 80% of the 15,000 go into admin, and 20% of the 15,000 to go into bill or to go into distribution costs. So 80% was 12,000 into admin, and then 20% was 3,000 going into buildings depreciation in the distribution costs. Okay, so that's the buildings one. Now remember we revalued our buildings, right? 180 of it went into the revaluation reserve up above at the cost here, but now 75. So we have to add back in any depreciation that's ever occurred on that, on the buildings. At the start of the year, there was 60,000 accumulated depreciation, and now there is the 15,000 charge for the year. So we're going to have 75 to put into the revaluation reserve as well. So when we add the 180 and the 75, that's going to give us 255 reval reserve. Okay, in the finance buy section, okay, in the balance sheet. Next then, we were told depreciation is to be provided on for vehicles at a rate of 20% per annum on a reducing balance basis. So that's 25% of the net book value, whatever it was worth at that time. Okay, so at the start of the year we had 510 delivery vans. There was accumulated depreciation of 204. So our net book value was 306. Okay, so 306,000 multiplied by 20% is equal to 61,200. So that's the van's depreciation. Okay, so 61,200. That is going to go, okay, into the charge for the year here, and it's going to reduce our net book value from 306 to net book value at the end of the year 244,800. So 244,800. Okay, now we are going to put that depreciation delivery van into the distribution costs here, 61,200 euro into our distribution expenses. Okay, what we would do then is we would tot up all of our tangible fixed assets note while we are here. Okay, and then that 1,174,800 will go up. 1,174,800 will go into our intangible fixed assets in the balance sheet. Okay, so there is a lot to that adjustment. Okay, you need to practice a few of these tangible fixed assets notes before you get really used to them. So I would advise that you do that. But that is note number 5 done. Note number 6 then. The patent was acquired on the 1st of 1st, 2018 for €171,000. It is being amortised over 9 years in equal instalments. The amortisation is to be included in the cost of sales. Okay, so patent was acquired 2018 for 171. It's been amortised over 9 years. Okay, so 171 divided by 9 is €19,000. Okay, so they're saying that the patent written off, the amortisation is to be included in the cost of sales. Okay, so we will put that into the cost of sales. That's no problem. They're telling us where to put it. So we are adding that to the cost of sales working here. And then we will take the 19,000 away from the patent figure that we had, the 95,000, and that will give us €76,000 up in the fixed assets in the balance sheet. So that's a very quick adjustment then. Okay, adjustment number 7 then. The company is being sued by a former employee who is claiming unfair dismissal. The former employee is seeking compensation of €72,000, which is 2 years' wages. The company's legal team have advised that as all proper procedures were followed in the course of the dismissal, it is unlikely the compensation will have to be paid to the former employee. The company has received an invoice for legal fees to the value of €9,000. Okay, so company's been sued by former employee, unfair dismissal. They're seeking 72,000. However, the company's legal team have advised that as all proper procedures were followed, it's unlikely the compensation will have to be paid. However, we do have to pay the legal fees, right? So we don't have to pay the compensation, very unlikely, but we do have to pay the legal fees of €9,000. So this is a contingent liability, okay? What is a contingent liability? It's a possible obligation depending on whether some uncertain future event occurs, or a present obligation but payment is not probable, or the amount cannot be measured reliably. So what do we do with a probable and subject to reasonable estimation? So we record it in the financial statements. Reasonably possible, we put it as a footnote, but remote, no required disclosure. So look, we are just going to be putting it in as a footnote, right, if we're asked to do that. But state how a company would deal with a contingent liability which is possible but unlikely, right? So when a contingent liability, such as this one with unfair dismissals, is possible but unlikely, it is not necessary to make provision for it in the accounts. So we don't have to put the 72,000 2 years' wages into the accounts, right? But what we should do, we should have a note which shows the nature of the liability, an estimate of the amount, and an opinion regarding the outcome. So basically, we will have to say, we will have to talk about it in our notes, and we are actually asked to do it in note number 5, so we'll be writing it down there. So all we have to cater for here is the 9,000 legal fees. Okay, so we're going to add the 9,000 legal fees here. Okay, and then we're going to add that then into the other creditors as well, because we still have yet to pay that. Okay, so we have yet to pay that. We owe our lawyers then €9,000 for dealing with that. Okay, next step, you tot up your totals. Okay, so you're just totting everything up. It is very, very, very important that you leave the no notes. You do not put any notes here. I am all about writing the notes in question 1, but we're not allowed to do any workings here whatsoever. So any workings on the face of the accounts, you're going to be minus marks. So just make sure that you're leaving all of this blank, right? So you're just totting up all of your workings, and then hopefully you'll get the total net assets and the capital employed figure to equal. So that should take you no longer than 4 or 5 minutes. Don't spend much more time on it than that. What you want to do, if you're running out of time, just get going on to your notes and your theory. And if you have any time at all at the end, then you can come back and then you can have a look at trying to balance them all out. Okay. Step number 6 then, we'll complete the notes. So you're asked to do 5 notes here. Accounting policy note for tangible fixed assets and stock, Number 2, operating profit. Number 3, tangible fixed assets. Number 4, dividends. Number 5, contingent liability. Okay, so the accounting policy note for tangible fixed assets and stock. So this is what it looks like, okay? I'm going to highlight everything that you need to learn. So they're going to be written into your handout, into your notes for this topic. But you have to learn, right? Buildings were revalued at the end of the year and have been included in the accounts at the revalued amount. Depreciation is calculated in order to write off the value or cost of tangible fixed assets over their estimated useful economic life as follows. And so you're going to have whatever your fixed assets are. In this case, you've got buildings and delivery vans, and you're just going to take the information from the question. So 2% per annum straight line basis came from the question, and 20% per annum on a reducing balance basis came from the question. And then stocks are valued on a first in, first out basis at the lower of cost and net realisable value. So that's 5 marks for that. So you're just taking this from the question, this from the question, and you are learning off everything that you can see that's highlighted. Okay, operating profit note then is number 2. The operating profit is arrived at after charging. Okay, so our operating profit figure, if we go back here, all right, this is my operating profit figure. What is it arrived at after charging? What are all of the expenses that are included in here? So in our distribution, our admin, okay, we had auditors' fees, directors' fees, depreciation, legal fees, so you have to put in everything, that it was arrived at after charging, right? So we had legal fees, 9,000, auditors' fees, 16, directors' fees, 45, paid and amortised, 19, depreciation on tangible fixed assets, 76 too. So again, you're going to be learning off everything that will be included under this note, and then you're going to look for it in your question and just write out the figures that are associated with that item. Note number 3 then, you already have this done, and there's 7 marks for this. So you had your land and buildings and delivery vans, you had your disposal, your reval surplus, you had your accumulated depreciation for the year, you had your charges for the year, 1, 2, 3, 4, 5, 6, 7, 8. So you're getting marks for, I think, mostly everything that I have highlighted there, okay? So a lot of these figures, you're not getting any marks for us to see the total here, but you do need to tot everything up so that you get this figure for it to go into your balance sheet, okay? But only 7 marks. There's a lot of figures there, but a lot of them aren't worth anything, but they're helping you arrive at your net book value figure there. So we've already done that, so we'll move on quickly. Okay, so dividends then. So you can see here that we have dividends paid 27,000, okay? You can also see that we have ordinary shares 300,000, and you can see that we have 4% preference shares 250,000, okay? So 250,000 multiplied by 4% gives me €10,000, okay? So 250 multiplied by 4% preference shares, which is coming from here, that is €10,000. Now, I have 250,000 of them. If I divide the 10,000 by 250,000, I'm going to get that is 4 cents per share, okay? So 10,000 divided by 250,000 is equal to 4 cents per share, okay? So if I've paid 27,000 dividends altogether, but 10,000 of them have to be paid to my preference shareholders because they're paid 4%, okay, on whatever is invested, I'm going to have 17,000 euro left. Now, I've 300,000 ordinary shares. So if I divide 17,000, put that into my calculator, divide by 300,000, I'm going to get, multiply it by 100 to get the answer in cent, I'm going to have 5.66666, okay? So I change that up to 5.67 cent. So that is how we do the dividends. You'd be getting 1 mark for the ordinary dividend figure, 1 mark for the preference dividend figure, 1 mark for the 17, 1 mark for the 10,000 there. The last note, contingent liability. So this is all about our last note. So in the question, it read, the company's been sued by a former employee who is claiming unfair dismissal. The former employee is seeking compensation of €72,000, 2 years' wages. The company's legal team have advised that as all proper procedures were followed in the course of the dismissal, it is unlikely the compensation will have to be paid to the former employee. The company has received an invoice for legal fees to the value of €9,000. So all that's happened here, what I read out from the question and what you see here in front of you, is practically the same thing. Okay, so that is absolutely fine if you're just copying down the note from the question. There's not much change there. There's no particular way you have to write it. You're just writing the information down from that. So that's the notes completely done. Part B then, step 7 then will be to do part B, which is the theory. So you're looking at using, just don't spend longer than 4 minutes to do this, and then you'd have 4 minutes to read over your answer. So part 1 says, explain what's meant by an audit. So an audit is an examination of the financial statements of an enterprise by an auditor appointed by the ordinary shareholders who is independent of the business. So part B2 says outline the factors that an auditor will take into consideration when forming their opinion in order to prepare their report. So outline the factors that an auditor will take into consideration when forming their opinion in order to prepare their report. So they're going to want to know if the proper books of account have been maintained. They're going to want to know if accounting concepts, standards and policies have been correctly applied. They're going to want to know if they've been given access to all the relevant material. They're going to want to know if accounting policies have been applied consistently from previous years. They're going to want to know if all legal requirements have been met. Have the accounts been prepared according to the Companies Acts? Are the net assets greater than 50% of the issued share capital? And do the financial statements represent a true and fair view of the financial state of affairs of the business? So again, we're just going to look at this. If proper books of account have been maintained, if accounting concepts, standards and policies have been correctly applied, if they have been given access to all relevant material, if accounting policies have been applied consistently from previous years, if all legal requirements have been met, have the accounts been prepared according to the Companies Acts, are the net assets greater than 50% of the issued share capital, and do the financial statements represent a true and fair view of the financial state of affairs of the business? So unfortunately, published accounts, there is a lot of theory, there is a lot of notes that you have to learn off, but you do have to spend the time taking a look over those published accounts theory and the notes for sure, okay? Because we're not going to be getting a H1 in Leaving Cert accounting without putting emphasis on our theory. Okay, so that is the 2023 published account Goodwin Plc completed.